Welcome to Money Talk with Aaron Ricketts, presented by Ricketts & Associates, 3245 North Adrian Highway, Suite F. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial, or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. We welcome Aaron back into the studios once again. Hey, Aaron.
Hi, John.
Well, we're getting towards the end of the year. Lots of stuff happens around the end of the year, doesn't it?
It does. Lots of stuff.
Yeah, some important stuff, too.
Thanksgiving, Christmas, and why you shouldn't buy mutual funds before they pay distributions, which very often happens at the end of the year.
Bingo.
Okay. So to get to the simple part of this, I first want to say we're talking about after-tax mutual funds or owning after-tax mutual funds. So not retirement plan mutual funds, because they're not taxed until you take the money out. Tax-deferred accounts, not talking about those. We're talking about after-tax accounts. Some people have them titled in their individual names. They might have them titled in a joint name like husband and wife, or they might have them in a trust. So if you're managing your own investments or you have an advisor, you can think of it as, those accounts that might be just titled like in your joint name or in your trust name. We're talking about ownership of mutual funds. So, of course, mutual funds are types of investments that we all pool our money together, give it to a money manager, a mutual fund manager, and they invest it for us. So you may have 100 stocks, 100 bonds, 500 bonds, 200 stocks, whatever that mix is inside that mutual fund. There is going to be some trading going on, buying and selling. So that's what we're going to talk about, what happens to that and how mutual funds pay those distributions either monthly, quarterly, or annually, and how you should be watching that or be very cautious if you're looking to make an investment or a purchase right now in the market in a mutual fund. So,
but this is not like your 401k or anything like that.
Correct. Not talking about those retirement plans. So if that's all you got, you probably aren't concerned about this part, but it's something that you should always know. This is how this stuff works. So a common mistake investors make is buying a mutual fund just before they pay out dividends and capital gains. And capital gains often is the demon in all this that causes us grief. So buying before a distribution, it seems like a great idea. Most people look to that as free money, right? If you have a 5% capital gain distribution for XYZ mutual fund, you think, oh, I can buy it just before the release, the distribution, and I'm going to get 5% more in my account. It's not actually how it works, and it might actually cost you some money, some tax dollars. The way funds pay their distribution is slightly complex, but it's important to understand how they work to avoid these unnecessary problems. There are two types of distributions. I said dividends and capital gains. So in dividends, funds collect incomes from their holdings. So if they hold 100 stocks and 50 of them pay dividends, some do, some don't, they may retain that income within the fund and pay it out to shareholders in one lump sum at the end of the year. Some, again, pay, once a year, twice a year, or 4 times a year. It all depends on the particular mutual fund. Many of them pay right now at this time between mid-December and the end of December. So be careful again. I want to give you an example, see if we can follow along. For instance, when a fund with a total value of $1 million and 1,000 shares collects $50,000 in dividend income, that price of that stock rises from $10, right? So they're collecting this $50,000 of dividend income. That $10 a share price will go up to $10.05. Make sense? that 5 cents is passed along to the shareholders per share. That money comes out of the fund, and then the fund share cost, which I said was $10, will drop by a nickel because it's coming out of the mutual fund. As a result, the investor receives that 5 cents per share in the form of a dividend. Most of the time, what do we do with those dividends and capital gains? We reinvest them. So the share price then, because we did the distribution, comes right back into the account. It reduces that $10.05 price to $10 again, and you just own a nickel's more worth of shares because you just bought more shares. So because you received that income, the total value of the account stayed exactly the same the day after that the dividend was paid. That's how it works. And I probably could say that 20 times, and you probably still wouldn't quite get it. But the whole idea is that it's a wash. There's no change in how it's going to happen, how your account value is going to be, except that there's going to be a distribution, and you're going to get a 1099 about that. Let's talk about capital gains first. Capital gains work essentially the same way when a fund sells an investment at a profit. So remember I said some mutual funds may own 100 stock. So if they sell one of those stocks in there, they lock in a capital gain if they sell it higher than they bought it. At the year's end, the total amount of capital gains extends the value of the capital losses. So it's possible they could sell something that was for a loss. But if there's more gains than there is losses through that sale, or you could call it churning of the stocks, the fund must pass the net proceeds to the shareholders, to the mutual fund holder or owner. And same with dividends. These gains are already reflected in the fund's asset value. So whatever that value is, it's going to stay the same. It's going to be distributed and then reinvested, and everything you own is exactly the same. So the impact of this stuff is usually found in your taxes or on your tax return. So this is the Paul Harvey version, right? The rest of the story.
There you go.
Investors may have to pay taxes on these dividends and capital gains in their regular accounts, or what we call taxable accounts in our business, as to opposed to those distributions in the retirement accounts, right? In taxable accounts, the investor doesn't get to keep the distribution. They have to give up a portion of it for taxes. Dividends and short-term capital gains are taxed at regular income. So it goes on to your tax return, and then even, I say goes on it, through that 1099 that you received from your brokerage firm or from your mutual fund company, that data goes on your tax return. And then in essence, because it's reinvested typically, you're paying you could be paying taxes on phantom income. Dividends, depending on the type of account it is, could be as high as 3, 4, 5%. So if you have a $100,000 account that paid a 3% dividend yield, that's what came out, that's $3,000. All it did was get reinvested in the account, and it is possible that it created some value inside your account. But just remember, if you're not taking that as income, those dividends or that $3,000 goes on your tax return, and it's taxed as ordinary income. So if you're in the 10% bracket, you're going to pay $300 on it. If you're in the 12% bracket, you see where I'm going. It just continues to increase. So you just got to be aware of the timing. So the tax bite, possible tax bite, isn't the only reason not to invest. Because it's possible that, paying taxes means that you have made money. Very possible. But you can see if you bought right now today, XYZ mutual fund, and they have a 5% capital gains payout for the entire year of 2019, you get to be a part of that. You're a collective part of that. And if you didn't enjoy the overall 15-20% gain in that mutual fund, you're going to pay taxes on something that you don't even have a gain out of. So just be careful. If you have bonds or bond funds, it usually isn't a problem, or isn't as much of a problem. because the distributions occur each month. So the dividends that are paid, bond interest, they call them dividends often, they will be paid out monthly. And so if you buy today, you're not collecting an entire 11 months worth of capital gains. Because they're paid out through a monthly payment. But income-oriented investors who also hold stock funds are looking for those higher yields often. They're the ones that kind of sometimes get caught up in this issue because some of the types of bond funds, they won't do a lot of buying and selling, but when they do, it could create a lot of capital gains for you. Most mutual funds pay out capital gains in the final week, I should say throughout December, but it's the final 2 weeks of December typically. And you can do a quick search on the internet and just type in your mutual fund and say, what is the capital gains record date or tax date, distribution date, and you'll get all that information. It comes out pretty quick. Through our company, every single company or mutual fund that we use, they send us that information. Typically, it's out sometimes in October. They will give you at least an estimate of what that will be, especially with some of our larger accounts. You know, the market has done so well over the last 10 years. Last year was a bit of a reprieve because, you know, the S&P 500 was down about 4.5%. So not all your mutual funds are targeted to the 500 largest companies. You own mid cap, small cap, bonds, a mixture of value and growth. But that particular last year, saw a decline. So this year, the payout might not be, for many of the stocks, might not be as rough as it was a year before. Because when the market goes down 4.5%, it makes sense, or you would think it would make sense, that your capital gains distributions would be less, would be negative. Not so much, because it's banking on all those other months or quarters that you actually had positive results, and before you know it, it caused you a capital gain. And it also happens in years that it's very volatile, like it was in 18. Lots of, run-ups, 10, 15% run-ups, and it was down 10, 15%. I think we had 3 of those last year. When that happens, very often there is a movement, right, that actually causes that. So it's not it's not a result of that, it's what caused that. When markets drop 10%, somebody's selling. That's pushing the market down. When the market goes up 10%, that means somebody's buying. A lot of people are buying. So you could see that many mutual fund managers can get caught up in that, where they're going to take some profits and try to control their losses, on certain securities. And what happens typically is then they start harvesting a lot of capital gains, right? Because they're trying to protect their investors on the downside, and they distribute that all to the general public. So I just tell people you should be talking to your advisor if you have one about this subject. Whenever I get money and I just open an account for somebody and made an investment, I went through this situation, this scenario. So not to say it's not okay to buy in, because not all mutual funds have large gains. Some might even have some losses, and you can buy into those too. But you want to be very careful, especially with large accounts, that, if somebody's writing a check for $250,000 and you're buying a mutual fund that's got 5% gain, that can be a pretty good tax bite. And you know what? They get that 1099 in just a couple months. So investing and then that 1099 is fresh in their minds. So you want to be careful and make sure our clients are taken care of, but also you as an investor know these are the rules. It doesn't hurt to wait a week or two, right? To do an investment if you're, maybe a little confused about how that stuff works. But if you got questions, give me a call, 265-3540.
That's Money Talk with Aaron Ricketts, presented by Ricketts, Ricketts & Associates, 3245 North Adrian Highway, Suite L. The opinions voiced on Money Talk are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. Join us once again next week for Money Talk here on 103.9 WLEN.